Okay, so we'll be doing options trading on Investopedia, and while we do that, we have to keep in mind what OBGs actually wanted from us. So that's the basic requirement. You have to buy a call option on a stock that is bullish, put option on a stock that is bearish, and while you do all that, you have to implement 3 of these strategies right here. I'll be covering everything starting from the very basics. So you find your way to the browser and hit the stock simulator, and under the trading tab right here, you find trade option. You click here. Now in this box, you have to type the name of the company or the stock that you want to get the options of. Say, for example, we could try Tesla. Now, unfortunately for me, when I do this, this is what I get. It means it's not working for me. And if this is the same case for you, you have to switch the browser. And it has something to do with Java. Again, unfortunately for me, Internet Explorer is the only thing working. So don't judge. I type the name here, and something like this should appear. If this appears, it means it's working. Then you hit Get Options. This is what you're going to get once it's working. These are basically all the options available for this specific expiration date. I could change the date depending on my analysis, say November 8th. These are all the options for that expiration date. The blue highlighted options are in the money options, whereas the white ones are out of the money. Same for calls and puts. And these are the contract prices, the last prices of the option contracts. And as you can see, the blue ones cost more than the white ones. You don't have to be concerned about the bid and ask and volume and open interest. The way we're going to do our analysis, these two, they don't matter as much. But make sure volume and open interest, these two particular items are high enough to provide you enough liquidity so that you can do your trades. Otherwise, you might not make the profit even if you did your analysis properly. Also, if you can see right here, these are near the money. You can also click on in the money, which will show only in the money options available for both calls and puts. You could also do it for out of the money, but it's always better to do it near the money. This will help you make your straddles and strangles and whatever you want to craft. Say, for example, we want to buy this option. We click on it, and now we have 2 ways available to us. We can either buy to open or sell to close. Now, buy to open means that you're taking a long position. I mean, you're being a holder of a call or holder of a put option. And sell to close means that you're selling the option that you just bought. And it does not mean that you're being the writer of an option. So that's the thing about Investopedia. You can buy an option and then later on sell it, but you can't be the writer of any option. If it could, it would show you an option like sell to open, then buy to close. So there's that. And this is why we wouldn't be able to apply some of these strategies, which we'll be talking about a bit later. All right, then we buy to open. We cannot sell to close because we haven't bought any options yet. We buy to open, then say I want to buy 1 contract. Then it could be a market or a limit order depending on how you want it to be. Preview the order, and this is a basic breakdown. Now don't make the quantity too high because it should be around 1 or 2, because 1 contract gives it the right to buy 100 of the shares. So I keep it between 1 and 2. Then you submit the order, and that's when you see the order to be executed. Now I'm not going to execute the order because I've already closed my portfolio, but once it's done, it's going to look something like this. For a while, it's going to be here. Then once it's executed, it's going to be in your portfolio. And after a few days, it's going to show profit or loss, and you know the rest. Now, as for the strategies, we're required to buy a call option on a stock that is bullish, and this one and these strategies. However, by doing straddle and strangle, we can exhaust these 2 requirements as well. And I'll show you how. So let's talk about straddle first. So how do we know when to do straddle and when to do strangle? We do straddle basically when we know the price of a stock is either going to go significantly up or down. And we don't know the direction of it. So something is going to cause this significant movement in the price. Say I could show it with an example for Tesla. Go to trading view, find Tesla. And this is what I did. These E's, they represent the earnings announcement dates. They could either be positive or negative, because a negative news could impact the share in a different way compared to a positive news. So I did my straddle right here. I made a straddle at this point, knowing that the next earnings announcement date was going to be here around 24th of July. And the price right here, as you can see, as it approached this date, significantly went down. This was due to the news, obviously, earnings announcement news. Maybe it was negative and that's where it went down. And I capitalized on it and I made some huge amounts of money. Let's show it with a different example, AMD, what you could do to make a straddle. As you can see, the earnings announcement date, the next one is around 29th of January. And this specific AMD stock is bullish. It's going up, which can be seen from this trend line. So let's make a straddle with AMD stock, which is also bullish. Okay, so we hit the options trading menu now, right here. We find options for AMD. Now the date specifically was around 29th of January. Now the expiry date of your contract doesn't need to be exactly this date. It could be before, a bit before, but not obviously after. It could be 20th January or something like that. Anything close to that would work, because you might not always find a specific contract with that date. So the closest that we can have, as you can see right here, these are the available options for November 1st, but we want the option for January 20 or 24. This could be the closest one. So we click on this. Now you might see that there's an option called straddle right here. When you click on it, they actually show you, they picturize it for you, but you can't do anything from here. It's just a better way of organizing it. But again, you have to do all the things from here. These are the strike prices on the left. So for example, if I want to make a straddle with this specific contract, I buy this call with a strike price of $33. I open it in a new tab and do what we did before. We buy the contract. We could buy only one contract, and we do the same thing for a put option. This is the equivalent put option with the $33 strike price. We buy it as well. The quantity has to be the same, one call and one for put. And once we buy these two contracts, we've already made ourselves a straddle. Now by doing this straddle, what we did was we found a stock that was bullish, which is apparent from this trend line, and we made a straddle with it. So we exhausted this part and this part. Now what we could do is we could make a strangle using one of the bearish stocks, buying a put option on a bearish stock that would consume both of these strategies. Now the real question is, when do we do strangle, right? The main difference between straddle and strangle is that in case of strangle, the strike prices are different. There are two different strike prices. And the reason why we do strangle is because, unlike straddle, in case of strangle, we have a directional bias. We know that the stock price is going to go at a certain direction more likely than the other one. In case of straddle, we didn't know that. So if we buy a put option on a bearish stock with a strike price and a call option on a bullish stock, or on the same stock with a different strike price, the lower strike price, then we make a bear strangle. And by making this bear strangle, we're actually consuming this part and this part at the same time. So we don't have to make more trades. We're doing both of these. Well, again, the fact that we're doing a bear strangle is because we want to do two of these things together. We could have also done a bull strangle. The difference is, in case of bull strangle, the strike price of the call option that you buy on the stock is higher than compared to the strike price of the put option. And in case of bear strangle, the opposite. So we will have to buy a put option that has a higher strike price than a call option, and we have to make sure the put option that we buy is also on a bearish stock. So let's find a bearish stock first. Yeah, we have to hit trading view again in order to find a bearish stock. There's already Walmart in here. I was working with it. Okay, after doing some research, I think I found a bearish stock, as you can see right here, Netflix. If I draw a downtrend line from here to here, as you can see, it's going down, straight down, and there's also been a breakaway gap right here in this region, which also bolstered the fact that it's a bearish stock. So yeah, we have to make a strangle on this bearish stock, Netflix. Let's go to it. We go to Internet Explorer again. Trade option. The ticker symbol of Netflix. Get options. So I like to repeat something again. It's a bearish strangle. So the strike price of the put option is higher than the strike price of the call option, because we are sure, or we are kind of biased towards the downward move of the stock price, because it's a bearish strangle. Had it been a bullish strangle, what we would have done is we would have bought a call option with a higher strike price than compared to a put option. So because we knew that the stock price is more likely to go up. So let's get back to making the bearish strangle. We buy this 295 strike price, this put option, then we buy this call option, 290 strike price, which is less than 295. And you'll also notice that this put option is in the money but this call option is out of the money. And out of the money options are less likely to be exercised and less valuable, and that's why it costs about only $1, $1.27, whereas this costs about $7.10, which is a lot. You could also buy this if you want, the middle one, but not this, because then it would have the same strike price and it would be kind of a straddle. And now, if we wanted to make a bull strangle here, which we will not, but if you still are wondering, we would have bought this and any of this. So what we did was, this call option is in the money, cost about $2.34, and this put option is out of the money with a lower strike price and cost about only 73 cents. So after buying these two, we complete our strangle, whatever we wanted to make, in this case bear strangle. So at the first case we did our straddle, and then we did our bear strangle, and after doing all this, what I got here is what I already showed, this. So this was my straddle, I think, on Tesla. This was my strangle on AMD, and due to the earnings announcement, the price significantly moved, and that's why it's a very positive figure right here. I made about $3,445 here. Also, I made some money in the strangle that I did on AMD, and the AMD stock was I think bearish, so yeah, it worked out for me. So by doing these 4 trades, I did all the requirements that he mentioned in the sheet or whatever. Now here's the thing I would like to repeat again. These 3 strategies, all of them requires you to simultaneously buy a call option and sell a call option, meaning being the holder of an option, or holder of a put option, and a writer of a put option or writer of a call option. These are basically, that's why they are called spread. The spread between simultaneously selling and buying an options contract. And butterfly strategy is also a combination of bull spread and bear spread. But as we've talked about before, in Investopedia you can't be the writer of any options. So I've talked to Sir as well, and he knows we can't do any of these 3. So the only things left for us to do is these 2. And we've already done it. We've already consumed these 2, and that concludes the options trading part. So I think, yeah, that's it. We're good. Thank you for listening.